Here we go, getting ready. I see you out there. Everyone, Mitch Goldberg is live. Thank you so much for joining me. Yeah, we're just getting started a couple of minutes late. It's one of those days. I've just been all over the place. You ever have a day like that? You just like wonder how you get anything done today? That day was today. So we've got a couple of things to talk about, but I really want to get in touch with you. Like I want to get in touch with you. I don't know why I said that. I want to speak with you about the rapid rise in interest rates and some of the things that you'd expect to happen, some of the things that are not happening. But holy cow, interest rates are soaring. And when I talk to you about what mortgage rates are doing right now, you're going to be like, holy, you know what? They're that high. So let's roll the intro. We're going to do a quick update in the market. We'll talk about some financing things and what maybe you should be doing now that long term rates are moving up. So we'll roll the quick intro and stick around. It's going to be a good show. If you have any questions, you know what to do. Hit me up in the comments. Words of wisdom, words of encouragement. They're always appreciated in the comments. You know what to do. Give the show a thumbs up, a heart, a celebrate, whatever the reaction is, depending on your preferred platform that you're watching me on. And here we go. All right. Thank you for joining me. If you're tuning in just now, what we are talking about is an overview of the stock market. I call this your post stock market show, the business news that you need to know. I want to get more in, I get more into details, nuance, not just telling you what the major averages did and what stock was up the most and why. That's not really something you can use. Typically, whatever the stock that was up the most in a day, the news disappears the next day and then we don't talk about it anymore. I really want to make sure you have a really deep understanding about the world of finance because you have decisions to make. And number one, you want to make those decisions with confidence. Number two, you want to make sure that you could stick with those decisions. And number three, you want to make sure that if you do need to make a change because you made a mistake, that you could pivot. You know, pivoting is very important. I think that is so funny. So that is something that we need to do. Excuse me. I have like the most horrendous cold. I've had the worst cough for a couple of days. So let's just get into it right now. The market was, generally speaking, another good day. Yesterday, we had a little bit of give back after a real huge rally last week, biggest rally since late 2020 last week. We were off a little bit yesterday, but nothing special. The blame yesterday was rising rates. But today, the major averages, you know, the Dow, the S&P 500, the Nasdaq. You cannot invest, by the way, directly into an index, but you could invest directly into a security that tracks or mimics an index. I have to say that. But today, rates were still up, and now the stock market turned up. So, what is the deal? Are we having an economic slowdown? It seems pretty agreeable across the board that I'm seeing comments all over the place. Like the Fed has lost decades of credibility as an inflation fighter because of the inflation scenario now and all the money they pumped into the economy. So did it lose its reputation as a great inflation fighter? It looks like that right now, but we have to give it more time. Uh, some people are saying the next couple of rate hikes are going to be 50 basis points. Just to make sure my volume is okay. They could hit 50 basis points over the next few meetings or just 25 basis points. We don't really know. What we do know is that inflation is raging. The excuse to call it transitory was that once supply chain issues around the world resolve themselves, especially because of COVID, that more production worldwide, more manufacturing, and prices would go down. It hasn't happened yet. There's a shortage of everything from semiconductors to auto parts to food, you name it. And now oil is very expensive. The war in Ukraine does not make things any better. So this is a very tough environment to make a decision. I don't mean to be looking not at the camera, but I feel like my volume button for my headset is a little goofy right now. So there's a couple things to talk about, and it's like, how do you make heads or tails of this? If rates are going up, shouldn't the market be going down? If the Fed is tightening, I look. Yesterday we went over what's good in the hood. What's good in the world, what's making the market work, and corporate earnings are holding up pretty good. They're expected to hold up pretty well in the good companies. When I say good companies, let me distinguish what I mean. Let me explain that. Companies that are self-funding, that don't need to go back to the public markets to raise money to survive, those are the good ones. A company that needs to constantly dump more stock into the market to raise more money to stay in business, those are the bad ones. Now, a year ago, those were the good ones, but now they're the bad ones. Okay, so that's how I distinguish between good and bad. Let's get rid of good and bad. Let's say um, desirable versus undesirable in the eyes of investors at this present moment. That would be a better way to say it. So the markets are up today. So what was the excuse today for the markets being up? If interest rates were up yesterday and made stocks go down, and interest rates were up today and stocks went up, we're trying to, you know, we're trying to make heads or tails of this. And that's why, investing is so difficult these days. But when you start to understand for yourself that a lot of the stuff doesn't matter and markets, investors change their minds quickly, you are more apt to hold on to what you have and give your investments time to work instead of trying to manipulate your trading and your stocks and your ETFs, make changes to your 401k so you could maybe protect your account. Then when the account goes down, the market goes down, you'll jump back in. None of that stuff is working too well, folks. So I'm not encouraging it um, on the show. I'm not somebody who says you shouldn't trade. If you decide you want to learn how to trade and you can afford it, and you have a little bit of money in the sidelines to do it, go ahead, have fun. As long as you understand that it's a learning experience and it's fun. It's when people don't realize that they are lousy at trading and then they keep replenishing their trading account with their long-term investment money or their savings, and they keep running through their money on trading and losing. That's not a good thing. You have to know when to say, this is not for me. And if you don't know when to say, this is not for me, well, you may have a gambling problem. So maybe you need to figure that out. For those of you who need to hear that, of course, which is probably not a lot of uh, viewers. Howard is out there. Howard asks, would you feel comfortable putting new money to work right now? All right. That is such a great question. I think it's like the most important question anyone's asked me on the show, and I've been doing this a long time. So let me answer this by saying it depends. Are you putting this money away now because you're not going to need it for 10 years or more, 15 years? Now is a great time to invest. Okay. It really depends on your time horizon. If you're asking me, is now a good time to invest? Maybe if I wait 3 months or 6 months or a year, maybe the stock market will go down 30, 40, 50%. I'll get a great price to get in and I'll do so much better. And in 3 or 4 years, I'll turn that money into such a big pot of gold. The short answer is, I don't know. I think you could invest some of the money on the sidelines now and hold on to some of it in case that calamity in the market does happen. But look what happened with the market 2 weeks ago, how much it went down. And the major averages have recouped about half their losses. Now, is this just a dead cat bounce, or is it just a pause in the selling and then we go even lower? it's really tough to say. I could give you all the reasons why we should go lower, and I could give you all the reasons why we go higher. I think right now they're pretty evenly balanced. So really tough to say. It depends on your time horizon. I don't want anyone playing with money that they're going to need by investing now or not investing now. I don't want anybody making decisions based on short-term events if it's money you need. That's all. And you know that. We talk about this once in a while. So it's a good question. If you're It's a great question. If you're investing in your IRA for the long term, your 401k for the long term, yes, now is a good time to invest. If you're investing money that you are going to need in the next year or two, I would say no, it's not a good time to invest new money. Simple as that. All right, let's take a look at today's action. ACTION. We want action. Thank you very much, Howard. Okay, so the Dow up 254 points. Not a bad day. Nasdaq up almost 2%. You can see the S&P up over 1%. Gold is going down. That's a good thing when gold goes down because that means people are less worried about inflation. They're less worried about a market calamity. Oil came down a little bit. Oil kept hitting 130 per barrel and kept backing off. There's an undertone of worry about inflation, and the smartest people out there, like Carl Icahn, a little while ago, Carl Icahn said today, there very well could be a recession or even worse. Okay, so that's a could be. Yeah, it's like when you hear people in the media talk about the market. We're not out of the woods yet. Things could get worse. We need to see how the next employment figure is going to turn out. The next inflation figure, how that's going to turn out. The next purchasing managers index figure, how that's going to turn out. The next GDP, and so on, and so on. Am I making you nauseous by doing that? I could do this one too. Okay. But there's always going to be something to worry about. There will always be the next economic statistic around the corner, the big bad boogeyman around the corner that's going to go out and bite your head off as soon as you turn that corner. There will not be a time when there's nothing to worry about with regard to investments. We're in a global economy with, I think, 8 billion people, and there are people making decisions all the time that affect everything. And people get together in the aggregate, and trends become evident, and that moves things. But staying on track here, there could be a recession next year. There could be something worse than a recession next year. Could. I don't let something like that scare me personally or my investment money out of the market. I don't change my personal finance habits because there could be a recession. And I'm not one of these people who lives like there's a recession and I hide under my desk and lock my wallet in a safe and forget the combination. I live my life the same consistently. What I mean by that is I practice good personal finance habits. Don't overspend, avoid credit card debt. What else could you do, right? Invest, take a little bit of money out of your paycheck before you spend the rest of your paycheck. You don't want to be in the position of always seeing what's left over after you're spending to invest and to save, because what happens often is there's nothing. So you want to invest first and learn to live without that, let's say 5 or 10% of the money you invest before you spend when you receive your paycheck. So if your paycheck is $1,000, you want to make sure you put $50 or $100 away into another account. And this, you've got, let's say, $950 for your spending, okay, for your needs and your discretionary spending. That's the way I do it. I'm not changing something. And you know what? Carl Icahn says there could be a recession. I've seen so many people, the same people over and over, say there could be a recession. There could be something worse. We still have to wait to see what the Fed does. We need to see what happens with Russia and Ukraine. We need to see if the Fed keeps raising rates. We need to see this. We need to see that. If you're waiting for these problems to be resolved, I promise you, by the time they are resolved, you will be looking at a new set of problems that need to be resolved. And just because somebody says that, I can tell you we could avoid a recession. Things could be really good in a year. The economy could be slow and steady, and unemployment could remain low, and inflation could come down, and earnings could continue to be strong. And all of a sudden, the Dow is trading upwards, hitting figures like 40 or 45,000. All right. That could happen. So we don't want to get into this. Should you wait or should you not? I could do a whole show. Just should you wait or should you not? Should I go or should I stay now? Yeah, that's what I'm thinking of, right? The Clash. It's like 1983, right? Okay. So I wish I had a little music clip of that right now. That would be a good idea. I have to do that. So we'll see what happens. So let's get back to what we were looking at in U.S. markets. Okay, oil continuing to come down. This is the big thing that I want to show you, though. The 10-year Treasury, it's almost 2.4%. Like people were saying earlier this year, we might see the high twos, 2%. That's about it. We really don't have much of a reason for the market to go up, for bond yields to go up much more than that. There's still, this inflation's not going to last. Well, here we are at 2.4%. Once we hit 2.5%, which looks like it'll happen pretty quickly, no guarantee, this is just my opinion, then we're going to be looking at 3%. At 3% on a 10-year Treasury yield, that starts to become enough of a yield for stock market investors to say, I'm comfortable getting 3%. I'll give up on capital gains from stocks. Fact is, a lot of people have a lot of gains in stocks right now. So maybe you'll take your gains and say, I'm going to protect what I have and just get a steady 3% guarantee from the government. Okay. The VIX coming down, I would say just about the low 20s, 22.94. We see that break through 20. I'm telling you, we have a rally. I'm telling you. What else do we want to look at? All right. So this is what I want to show you. All right. This is the article here. Mortgage rates are surging faster than expected, prompting economists to lower their home sales forecasts. All right. So let's take a look here. The average rate now on the popular 30-year fixed mortgage hit 4.72%. Holy shit. We could see mortgage rates at 5% very soon. Wow. 5% mortgage rates? That is, I mean, we are so used to seeing low 3%, high 2%, maybe mid 3% mortgage rates. And people are thinking, where did that come from? So that makes the cost of paying off your house, it makes your mortgage payment so much higher. And so let's take a look here. This is a chart. This is from the St. Louis branch of the Federal Reserve, the Fed charts. The 30-year fixed rate, okay, in the last year. Look at this. From about 3% March of 2021 to almost 5%. Okay. Well, this is from March 17th, but we know it's now 4.72%. This is through February. And look what it did. So this is the chart of the day. We're gonna have two charts of the day because we have to look at the Fed chart for home sales. Home sales are kind of sloping up. Oh, damn it. Am I showing you this? All right. Let me go back for a second. This is the yield, the 30-year mortgage rate. All right. This is what I was looking at. Okay. It's almost 5% from 3% early in the year. It's a big jump, folks. And then this is chart of the day. We have two charts of the day. The second one is look at this. This is existing home sales going up, going up, going up, and plunge. That is ugly. That's a nasty looking chart. This is home sales. This is through February. It's probably even a little bit worse through March. Okay, because we're almost at the end of March already. So rates are going up, and you see how quickly that affected home sales. Now, home sales are down because also There's limited inventory, so the median price of homes has gone up, but the affordability of a home now that's gone up and the payments are up so much. It's just affordability of a home is getting absolutely freaking crushed. So if you bought a house a while ago, you're protected with low rates. So that's kind of like you've inflation proofed your home living situation. Can't speak for your real estate taxes. That's a different story. But at least as far as a mortgage rate goes, you've inflation proofed yourself from that. Not to say that the cost of materials to do home repairs isn't going up, because that is definitely going up. But if you look at this chart, excuse me, I'm telling you, I've got this cough. Can't get rid of it. If you look at this, existing home sales are just plunging. This is a big drop. Could be because inventories are low, but also I think it's because the affordability is just being sucked out of the housing market. So that's really what's going on. And this is why I think it's such a surprise that uh, the stock market is moving up, with rates moving this quick. I'm surprised there aren't some more dislocations. Now, this has been good for bank stocks because finally long rates are going up a little quicker than short rates. So the difference between short term rates and long term rates is steepening a little bit. It's getting wider. The wider it gets, the better it is for banks. Eventually, lending rates, because if interest rates go up, eventually loan rates go up so much that it slows down business. At some point, enough businesses are going to say, I can't afford to borrow at this rate. And that means that they won't have money to reinvest, or they won't be able to grow. They won't be able to use credit to grow. And some businesses that need money won't be able to get their hands on any more credit lines. So eventually that would cause a slowdown in the economy, and the Fed would then have to start to act by lowering rates. But right now, everything that we understand is that the Fed is a long way from lowering rates. The Fed is a short way from raising rates pretty substantially. And when that happens, the Fed sends the economy into a recession. And that's why people are calling for a recession. The Fed is trying to engineer a soft landing, tamping down inflation without sending the U.S. economy into a recession. Can that happen? It could happen, but the odds are that it won't happen based on history. And this is why people are saying, I'm not trusting the Fed to engineer a soft landing. The Fed should do its job, raise rates, tamp down inflation, the economy be damned. But the Fed is trying to protect too many things, like the stock market, the bond market, the housing market, the labor market, and the overall economy. And while it fights inflation, but it's really tough to fight on all of these battles. And this is like the big question of our time. Can the Fed engineer a soft landing and fight all these battles without hurting the economy? And if you knew that, that's the $64 trillion question. And that's why the market is having these zigs and these zags, because one way or another, investors are moving further toward one answer or the other. And that's what's making the stock market go up and down so much in the last couple of months. Really, since Thanksgiving is when the market really started to see all this volatility. All right. So I hope that helps explain things to you. And if you do have any questions, you hit me up in the comments. I'm going to get going because, you have things to do and so do I. So I'll be back tomorrow, and I hope you will too. Thank you very much.